I think most things in fintech will just be much more natural extensions of what we're seeing. I mean, there'll be zero friction making payments. If you qualify for a loan, how credit is monitored. These things are going to be completely seamless. So I don't know if we're going to have chips in our brain or linked to our phones or, some hologram that pops up. But I think it's just about there'll be zero friction. It'll be totally just part of everyday life and not in a overbearing way.
Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is a big part of that effort. Today, we have Mike Packer, partner of QED Investors, on the pod. QED is one of the big dogs in fintech investing. They have roughly $5 billion of assets under management, and the firm was founded by one of the founders of Capital One. Now, we obviously get into all things fintech in this conversation, but we also dive into Latin America, where Mike happens to focus his investing efforts. If you're interested in either fintech or Latam, or the intersection of the two, this pod is for you. Enjoy. This episode is brought to you by Bowery Legal. Bowery Legal provides a complete range of legal services to high-growth companies. They do everything from formation, employment, partnership agreements, stock grants, corporate matters, and venture capital and debt financings. If you're interested in learning more, visit bowerylegal.com. Mike, thanks for being here, dude.
Thanks for having me, Mark, and Interplay. It's great to be here.
Very cool. I am excited to get into this. There's a lot of stuff I want to learn from you. Could you start off by giving us an overview of QED?
For sure. So we're an early stage fintech focused venture firm. We focus globally with a few exceptions, but pretty spread around the world at this point. We've been around for about 15 years, about $5 billion under management, and 21 people are on our investment team. Currently investing out of a pair of funds that equal about $1 billion, half focused on the early stage and half focused on growth. And we are very actively looking for high growth fintech investments and the future winners.
What's the profile? It sounds like there's two sides to the house, the early stage and the growth. But if you were going to give someone listening who's thinking about reaching out to you a profile, what is that?
Well, I think we maybe to our detriment, we're kind of suckers for anything fintech, and so we'll talk as early as anybody wants to reach out. We like trading ideas. A lot of us are former operators, really looking to kind of get into the weeds of how businesses are run and some of the strategy of how to build the initial stages of business. So we're really pretty flexible, but I'd say our sweet spot tends to be although all the terms we're speaking in August 22, all the round terms have kind of new meanings, but I think our typical sweet spot has been a Series A, where a company is starting to, if not found product market fit, has a few good hypotheses in terms of channel strategies and scale strategies. And so something that we can kind of work with in terms of data. But that said, I mean, we're really setting up our firm to go idea to IPO. And we want to be able to back, the best companies at any stage. And we want to also be high conviction investors. And so when we invest, at the seed stage or Series A stage, to your point, we're hoping to follow on with our winners in getting, 20, 30, $50 million into companies over the life and really set up to stay influential over time. So anybody in fintech who wants to talk, we're always open for business. And hopefully you'll find we know a little bit what we're talking about.
You do pre-seed?
We have done some pre-seed. We've been testing it a little bit, somewhat in reaction to the market last year, but probably more. Historically, we've done it with ideas that we've seen work in other places. So we've been fortunate to be part of founding a few companies with entrepreneurs, and from the very beginning of ideas and helping refine ideas. ClearScore in the UK, WageStream in the UK, Fairplay in Mexico, Minu in Mexico. Just a few examples of businesses we were involved in from the very beginning. And so, yeah, we kind of refer to that as a bit of a cheat code where we know the product has worked somewhere else. And we've kind of been part of those stories. We have a little bit more conviction on taking, that type of product risk.
And you guys typically lead?
We do like to lead. I mean, we're a large fund. The history of QED has been getting, is all about the fund getting bigger and bigger. And so part of the reality of that leads us, well, I guess to use a bit of a pun, but leads us to want to lead more because, getting the amount of capital work. But that usually comes in, again, at Series A or Series B. It's much more important. I think most of our seed efforts and pre-seed efforts are very much collaborative, with funds and with entrepreneurs and angels, and trying to just kind of be part of the learning and be part of the initial stages of a company. So we do tend to lead, and we do tend to take pretty active roles when we're making our investments. And so with that, a lot of times we're setting up the first board or the second iteration of boards and helping the companies get started on their governance journeys as well.
That's awesome. That's super helpful. I think most entrepreneurs aren't excited about governance process, but getting it right early can make relationships a lot easier.
Yeah, I don't know if we make it fun, but we certainly try to do it in a custom way for companies, because there's no one answer for governance or how to run a board, and we realize that. And I personally am learning a ton about how to influence and think about those types of things, because on one hand, it's really you have to do these things as the company gets bigger and managing capital. On the other, you don't want to get in the way of running a business and making sure that there's the right focus of delivering product and get, actually making progress.
B2B or B2C or both?
Both. I think we tended to be more B2C, as that's where a lot of our experiences have come from in the past. We've got a pretty strong tie to Capital One. So our founder of QED is Nigel Morris, who's one of the co-founders of Capital One. And I myself spent a bunch of time there, and a few of the other partners did as well. And so, through our experiences there, were a lot of B2C businesses. And B to small b, I would say we kind of throw in the same bucket in terms of small business space. But we do B2B, and we've done a bunch of things in the fintech infrastructure space we're pretty excited about, but we tend to not understand or really, especially early stage, like the ability to underwrite the sales cycles for large enterprise is something that we're not experts at, and that's a place where we particularly look to partner with other investors as well.
Yeah, that feels like a whole different animal sometimes. The super long sales cycle, huge ASP,
exactly,
customer concentration, the whole nut.
And if you don't know the segment really well that you're selling into, it's very, very hard to understand, what the buy decisions are based on. And so you could have best product in the world, but poor sales process, or even get outflanked by a simpler product with better kind of sales match. And so that's the dynamic. And again, I personally find that hard. I think some of my partners are a little better at that. But yeah, you're exactly right. We find that be pretty challenging.
Okay, so B2C, B to SMB, fintech, global. Are there characteristics that you're kind of looking for? Are you looking for marketing equation? What makes something in that world? What's the first lens after sector stage for you guys?
Yeah, I think it's a good question in terms of first lens, because I don't think we're necessarily consistent. I think we try to be, holistic, looking at, what's the potential business model? How do we see the market playing out, specifically in terms of how profit pools will move, or different kind of game theory of who can win. And then, of course, we think about the team a lot. So I think some version of those filters we're trying to work our way through when we see opportunities. And then, of course, there's some sectors or themes we might be a little bit more excited about at any given time. But those are really what we're trying to do. I mean, we're trying to make very long-term investments with particularly large outcomes, and not needing to do it overnight. And so needing to kind of see some of the path, or at least the initial path, and get convinced there is really what we spend a lot of time on.
Okay. Now, you mentioned this before, but I did a little homework too, and know you guys have increased your fund sizes substantially. And I want to distinguish between AUM and fund sizes. Often AUM is calculated as the carrying value of the company. So you might have put $2 million in, but if that position's now worth 20, you clock it at 20 on that count. But one of the big operating metrics that determines how you kind of scale a venture organization is how many dollars you're actually investing. And that's been going up for you guys, from what I understand. My read on the website was you guys have now deployed $650 million, which is pretty sizable. How has the size of the funds impacted how you guys operate?
Yeah, I mean, it's an amazing question, and one that, as you know, or as any fund would, we're kind of constantly, discussing internally. I think there's two or three things that made it more comfortable for us, and then I'll get to kind of your question. I think, we had come from a background where we didn't have external LPs. We were fortunate to have, particularly kind of Nigel, right, in investing our own capital in our first, three funds, so through 2016. And so as we started to think about, where QED goes, we realized that one of the big constraints we had was capital. And, for better or worse, one of the things you'll find at QED is we are very intellectually curious, very much this kind of hands-on approach. And, we found ourselves putting as much work into $1 million check as a $4 million check, and as much work into a $2 million position and a $20 million position, to use your numbers from before. And so this kind of bandwidth insight was something that had been playing itself out over time. And the other thing that kind of was happening is we were investing in multiple stages. Again, we just felt like we were under allocated from a check size. And so once those two realizations started kind of happening along the same time, being capital constrained, we realized that raising kind of at bigger funds, we could do basically the same strategy and same bandwidth, same partners, just a little larger capital. Of course, that changed some dynamics, which is your question. But that's been a bit of the theme. And so when I talked earlier about going from idea to IPO, we really used to have this little niche that we could find lightning in a bottle at Series A, write a $3-5 million check, maybe hope to follow on, and then that was that. Again, now we're talking about same level. Well, again, it's probably increased, but similar levels of conviction and activity and involvement, but larger checks. And so that's been the trend. I think the other thing, we've expanded geography, and so we've expanded the partnership because of that. And then, of course, the market has changed dramatically since we started all of this in 2017. Might be coming back to what we thought it was, just in terms of round sizes and valuations. So yeah, I mean, in terms of what we struggle with, I mean, we went from a world of really being able to cooperate with anyone, where if you wanted QED to invest alongside you, that was a lot easier to do. You as a generic kind of investor, and we found that was a good source of deal flow for QED early on, because we had this expertise. We were willing to kind of put in the time and effort. And so it was very easy for us to work alongside other funds. And then as our funds got bigger, our checks got bigger. So getting round dynamics, cap table dynamics together, put us more into competing for deals as opposed to working together for deals. And then I think the other challenge that we have is just where we get to double, triple, quadruple down now has a much more meaningful impact to our funds. Excuse me. And as fund size increases, of course, and we expect our cash on cash returns to come down, but we think the ability to back, really kind of sustainable, durable, long term, long term oriented companies and positions is where we can make a lot of money for our limited partners.
Yeah, the way I see it, there sounds like there's three levers to expanding your capital base operationally in a venture fund. Either have more partners, you do more deals per partner, larger volume, or you write larger checks per deal. And it sounds like the one you guys held constant from the sound of it was the deals per partner. And, it's interesting when you get to 21, you have 21 partners, right? That's a huge partnership for venture. I think kind of middle of the roads.
We have 21 investment professionals on the team.
Okay. I was curious how you guys make decisions, because one of the things that gets challenging in larger organizations is there's just no way to scale everyone getting as intimate and close with a deal when there's that many deals coming through. And then how do you figure out the politics of which deals get the follow-on capital? It's a big thing. And I think people probably don't think about this on the outside, but in a lot of firms, they do attribution, which means future LPs and everyone else can see which deal an individual partner did. And that becomes basically their personal track record, not just the firm's track record. And so you can have dynamics where partners are jockeying for the follow-on rounds for their companies versus other partners' companies, which may not be the optimal thing for all the LPs, just because they want to make sure they preserve their own personal track record. So how do you guys navigate a larger team? I'm always interested to hear best practices because I know it's something every firm has to grapple with and is thinking about. Any best practices or thoughts that have made this kind of sing for you guys? Because I know you guys you're got a functional operation over there.
No, I appreciate you having that perception of us.
You guys have a good reputation to market, buddy.
No, I mean, well, honestly, I think the thing that we have tried to be pretty dogmatic about is the number of deals per partner. And I think it's in times like we've been through the last 4 or 5 months where it really hits home. You've got 8, 9, 10, 15 companies calling you, and that's a lot. But when you're in 2021 and everyone's up and to the right, it feels like you can do more. And so I do think that gives us a little bit of flexibility. I mean, I don't think by any means have we, solved the, agency problem, the personal track record problem, the, there's, a whole host of things. But I think what we try to do, maybe two things, which I would say that we do pretty well. One is just in terms of like organizationally, how we've tried to organize, right? We organize by kind of sub teams within the group and try to create autonomy within those groups. And so I currently lead our Latam investments. So I'm not fighting with my partners who are focusing on the US or Africa, right? We're working as a Latam team to prioritize. Correct. And so that helps a little bit. We get to a place where we still have the potential to get to a place where we're having a capital allocation decision of a deal here or a deal there. But really what we're trying to do is just have really high conviction on the the absolute bar, right? And if we do that, then we all can kind of trust that it gets there. The other thing that we have is kind of escalation internally. So as exposure gets bigger, as capital gets tighter, as conflicts or decisions, more conflicts both internally, but conflicts in the portfolio, those decisions get a little bit more hairy. We're escalating those and having meetings. But to your point, I mean, during COVID, we had the 20 screen investment committee, or 20 square investment committees, and we realized that we can't do that for everything. So there was a bit of a trade-off there in terms of how we share information and work together. And I kind of lost my original framework, but I think the other thing that we really, really believe culturally is that we're better when we work together. And so how do we create the incentives that, when a good deal is done by one of my partners, or when I do a good deal, everybody is winning. And of course, that's about longer term incentives in a lot of ways. I mean, this game takes very long time to realize returns. And
it's a great way to get rich slowly. That's the VC mantra.
Yeah. Hopefully get rich slowly, right? Um, and yeah, but look, I think we have a lot of people who buy into that, and we spend a lot of time, trying to build those types of relationships and get the right people into our organization. We have some amazingly talented people, but I think one of the things that keeps us all together is this kind of culture thing, and part of that goes back years and years and years when Nigel and Frank have been working together for, I don't even know the years, but since before my career began. And I've known Bill Slufo for 15 years, and a bunch of us kind of have this kind of common language and trust, which we have to kind of bring others into the fold. But that's kind of the foundation. So I think some combination of that, but again, by no means do we have it solved for me. We've got meetings this week to talk about our current fund reserves and who thinks they're going to have deals coming up in the next couple quarters, and making sure we're okay with the allocation. Because the other thing we haven't done, which I think we may eventually have to do, is think a little bit more explicitly about allocations on a forward-looking basis. We don't make a lot of rules around, hey, you need to do this, put this much capital to work, or do this many deals, or whatever, which is good. But when things are moving, fast or hot, or when we're in a period of uncertainty, you have to be a little bit more kind of thoughtful about those things.
I feel like VC partnerships are a lot like marriages. The more you're talking about the relationship, the more you're talking about how you talk, that meta layer, you're kind of closer to not screwing it up. It's like half the battle. So it sounds like you guys are doing the hard work, which is talking about these things and try to figure them out, because otherwise they just kind of creep up on you. So,
no, I think that's the last thing anybody wants to happen, right? But I think the other thing, and this is a lot of credit to Nigel, right, is we've always thought about QED as a startup kind of within itself, right? And we've gone from when I joined in 2016, there was 6 of us. Now there's 20 plus on the investment team, and plus we have all the operations side of QED, which is now 10 plus. And so just the dynamics of kind of, okay, how do we build for this thing, and what's our alignment with long-term strategy, and a little bit of just kind of having all of us think through that lens of, hey, there's no necessarily like right answer here. We're still kind of learning. And, this is a big part, a lot of what QED does, right? Just like, hey, if it doesn't work, to your point, we need to talk about it. We need to talk about why it doesn't work, and then, try something new. And if that doesn't work, we're going to try something new. And part of that just is accepting the iteration of learning, and not wanting to make, same mistakes we've seen, in other places in the industry.
Yeah. I think entrepreneur types figure out pretty quickly, you never can get anything right for long, which is okay. And so you start looking for the thing to break. And once you start looking for it, you catch it earlier. So I think there's a little bit of there's a superpower in expecting something to crack. All right. You guys have nailed it. I mean, you become one of the preeminent names in the fintech side of the venture world now. I would love to dive into how you think about the fintech world. There's a hell of a lot in fintech, especially if you're touching B2B. I know it's more small businesses and consumer. It's almost a horizontal. I want to call it a vertical, but it's almost a horizontal. How do you think about segmenting the industry?
Yeah, I mean, it's an interesting, vertical versus horizontal thing. I mean, certainly, Andreessen coined the everything is fintech. A few years ago, Matt Harris at Bain kind of coined something similar to kind of the fifth, or I can't remember which number it was. I don't want to mess it up, but coined something very similar to how it's horizontal. And I think we agree. I mean, I think we think fintech touches everything, and so and we also think we're still in the extremely early innings. And so when we think about kind of segmenting it, we've got our own top down view of the world that's kind of manifested as different companies and strategies have evolved over the years. But I think more than anything, we're trying to stay in tune with almost the bottoms up view of the world. Where are we seeing opportunities pop up? Which type of which type of businesses or entrepreneurs more attracted to? What are the big problem statements that we're seeing early stage startups go after? So I think we come from it from a two pronged approach. I mean, we certainly can't cover everything. We're trying to be as proactive and research and hypothesis focused as we can. So dividing things up and kind of prioritizing a bit is super helpful. But yeah, I mean, I think the big categories are the ones you'd find on market maps. So we would agree. Payments, lending, infrastructure. We also focus on more and more focus on prop tech and insure tech, which we view as kind of these adjacencies because they have these really interesting elements of large transactions and risk taking. And so those are the primary spaces I think we're playing in. And then yeah, I think we try to do, back to the partnership example, right? Is formulate and talk internally about what are the interesting trends that we're seeing, and then just start tackling them like that. But the other thing I think we are also seeing is just a convergence of themes. I mean, a lot of what's happened in fintech over the last, let's call it 10 years, right, is really changing the front end, a little bit of product innovation, maybe some kind of access innovation, a lot of things on the data side, as there's been more and more data available and more power to analyze it. And so now it's really kind of about where the new category is going to merge, and where does the horizontal and vertical kind of align. So I don't know if I don't know if we've quite figured out where it's going to be, but there are a few places that we're very actively looking.
Ooh! Tell us. What's the future segmentation or sectors or opportunities in fintech?
Yeah, so I think again, we still have a lot of catch up to do, and depending on your view of the world of how much of banking will be reinvented and how much of financial services will be integrated to other things, or just like fintech is what it is today. All three of those scenarios are enormous markets. So, but yeah, when I talk about the future, I think that two or maybe three things that we're kind of actively thinking about. One is the whole embedded finance, embedded fintech, embedded X tech trend that you're seeing. So platforms, marketplaces, software that at the point of transactions can add financial services, or has a proprietary set of information about a certain client base, whether it's a consumer or small business or even enterprise, to be able to kind of streamline decision making, purchases, financing decisions, et cetera, within a given platform. We're very, very excited about that trend, and we're approaching it from a few different angles. One is fintech products or fintech companies that might have the chance to expand their business, because that's a very core part. The fintech option or the fintech product is a very core part of the value proposition. And then the flip side, right, which is how does a company that might be a marketplace or a software provider get the capability, skill set, organizational know-how to build fintech into their offering. And so I think you're going to see those companies emerge. And there's also an infrastructure kind of enablement layer, right? Is there an entire play where you can just say, hey, this type of software, you want to add this type of payments, click this button here, similar to kind of what I think Stripe has done in a lot of ways, but much more kind of integrated, I think, is the future. in an insurance, and the same thing, right? When you have this kind of point in time, it seems inevitable that those things are going to be much more streamlined, given the capability to kind of integrate technologies. The other one, which is on everyone's mind, is crypto, Web3, DeFi, whatever you want to call this leg of the world. And I think we've been slowly wading in and trying to learn and understand what's happening, what can happen. My partner Frank Rotman has some amazing threads on Twitter. Maybe we can find one or two to link here. But we a few of us have gone down that rabbit hole and trying to understand where the opportunities will come from. And there certainly seems to be some promise, particularly in DeFi, and thinking about the protocols and financial services that you can kind of build around and build on top of in a new world. So that's one we're particularly paying attention to and still seeing a lot of activity. A little bit more, high beta on where it's going to end up, but still seems to be pretty exciting opportunities in that space.
We just launched a blockchain fund at Interplay. I don't know if you knew that.
Mm-hmm.
Have you guys started to actually invest in the space, or you're still monitoring?
So we've made, it depends what you mean in the space, but in the kind of crypto Web3, DeFi space, I think we've made 3-4 investments, maybe a little more than that. But we primarily started making investments in some of the exchanges. So Bitso in Mexico was our first one. ShakePay in Canada we did. And so this was, again, back to your B2C question earlier, right? This was something we kind of understood as the consumer value proposition, something was happening. Of course, we had Coinbase as kind of an example or beacon here. So that was where we started. And then we started looking at a few things in the infrastructure space. So being able to add crypto to wallets, being able to put stable coins into, neobanks, challenger banks. That we've done a few things there. And then we recently announced an investment in the DeFi space, a company called Meow, which is, I think, one that we're really excited about and kind of have been excited to learn from them and hopefully help them as we look at kind of the traditional finance world learnings and lessons and how that'll impact things. So we've made a few, but we are definitely just getting started. And back to your other point about capital allocation, it's been one that has a wide bar on it for us, trying to figure out how to get more capital there, how to structure the team incentives right, as a whole host of things that we've been kind of talking about internally there.
So you made the point that we're in the early days of the fintech cycle, right? I think this is actually the year when George Jetson was supposed to be alive.
Yes, I feel like I saw on Twitter someone celebrating his birthday recently, right?
Yeah, maybe he was just born this year in 22. Hey, what does the future of this industry look like? Not the 3 to 5 year version with embedded finance and things that are kind of nascent but happening now. What's the 2050, 2060 reality we'll be living in with fintech if all this stuff comes to fruition?
I think most things in fintech will just be much more natural extensions of what we're seeing. I mean, there'll be zero friction making payments. If you qualify for a loan, how credit is monitored. These things are going to be completely seamless. So I don't know if we're going to have chips in our brain or linked to our phones or some hologram that pops up, but I think it's just about there'll be zero friction. It'll be totally just part of everyday life and not in a overbearing way. So like you won't even need to check your app to click to pay a bill. It'll all happen like automatically. So I think this automation, less friction, seamless, like people are just going to spend a lot less time there. I think that'll probably drive profit pools down. It probably makes banks, outside of money center banks, makes banks less relevant. You're still going to have a kind of, I'm not I'm more of a traditionalist in the sense that I would bet the Fed is still around and the dollar, is still around. But like, outside of the regulation and making sure that consumer protections are there, it's just going to be a lot more kind of free flowing activity because you can code all these things, right? It's beyond me of like if the AI will take over in 2032 or whatever, but I think that that's the inevitable thing. And so when you're buying a car in the future, you're not gonna have like it's very this is hopefully 3 years, but it's probably more like 10 to 15. You're not gonna have to sit in the finance department. Um, so yeah, I see it just much more open and integrated and seamless. And then I think the really, really big question, which depending on which side of the bed I wake up on, is how big are the banks? How big is fintech? How much of it is tech? Um, I could argue either side of that, but I tend to take the long view that banks are going to be around a lot in some way, shape, or form, like they are today, longer than I think most people think. Just because you kind of look at the history of financial services and regulation and impact of the political impacts of going through crises and just going through the instability that the world's going through right now. Like very, very hard to do that without banking regulation and central banks. I'm kind of taking a long view there, but I hope it'll look a lot better, and I hope it'll be more accessible and more affordable, especially when you look to. I mean, U.S. has its issues for sure, but you look around the world, there's a lot of impact that we can have, that we as a society, right, on other people's lives and well-being by making financial services available and affordable and usable for people as they're kind of growing into the middle class, or getting those first jobs, or moving from one end of a country to another. I mean, I work a lot in Latin America, and to see the impact that financial services can have on people's lives is hopefully something that comes from whatever we do right in the next 50 years.
Yeah, I think the thing that I take away from that, which I agree with, is seamlessness. No more forms, customer service, checkout lines, opacity of your information. I think this is just going to get easier and simpler and kind of move to the background. What does this sector need, right? As we're thinking about what's getting us between here and there, what are the constraints? Is it capital? Is it labor? What do entrepreneurs need to do to help move this forward? What does the market need? How can people contribute?
Yeah, I mean, I think that capital and labor seem to have not been issues recently, right? It's not a niche segment anymore in terms of investing in fintech companies and seeing the long-term opportunities. So there's certainly capital there. And I think, again, maybe recent months notwithstanding, right, the flow of talent to startups generally, but also into fintech from more traditional companies, banks, consulting firms, MBA graduates, engineering graduates. It's trending up, right? It's not. It hasn't been a huge issue. So I think there's probably an argument to be made at some point that there's too many fintech companies right now, but I don't think that means that we're all kind of focused on the biggest things. I think one of the dangers that we see in fintech is a lot of copycats, a lot of companies that are unsure of how they're really going to differentiate. And so I think that differentiation point is probably the biggest thing. But I think if entrepreneurs broadly are looking at problems that financial services create, like that's the thing that we need. We just need people who are long-term oriented or realistic about, again, movement of money and regulations and banking, right? To understand that this isn't going to happen, necessarily overnight for some of these things, and then the ability to really understand the problem. So I'd say for any would-be entrepreneurs, come on over, start talking about your ideas sooner than later. Really understand your problems, and I think there's plenty of room. But I would just I think it's really easy to, say, fintech's exciting or banks need to be recreated and then just try to create a prettier version of the same thing. I think that's a little bit of the, I think some reaction to what the market's having to valuations, is have we really questioning like how much have we really changed? And I think it's a very fair question for the sector.
Okay, I'm not going to miss this opportunity. You run the Latam practice at QED, and it seems to me that Latin America, as far as tech and innovation, has really awoken. Why Latam now? What's changed? Why is now the time you guys are putting your eyes down there versus 10 years ago, 15 years ago? What triggered this?
Well, we made our first investment 7 years ago in Brazil, and it happened to be Nubank, which was a very fortunate happenstance. And so I think what we've seen the last 7 years is talent coming in to the tech sector, regulators really opening the door for innovation, and the ability to create like a very resilient business model. And what I mean by that is, there are a lot of problems and a lot of issues, and solving those things have high rewards. And so if you get something right, like what Nubank was able to do in the banking and credit card space, and basically rebuilding everything from scratch, changing the experience, really moving the entire industry forward, the prizes can be quite large, because you build in this kind of resiliency in the business model. Really, what I mean by that is margins and unit economics. There's a lot of really good growth in a lot of these markets, but also the kind of value creating from the infrastructure. And so I think the more we've learned about Latam, and again, it's very hard to generalize Latin America because it's a lot of different countries, but like there are a lot of issues in a lot of sectors, and financial services is, usually a culprit for some of the bigger problems. And so that just has us keep getting excited about, different spaces and different opportunities, and that combined with the talent point, it's kind of a no brainer for us. So yeah, I mean, I think we're going to be, I've been kind of framing, we've been in LATAM for 7 years. I think we're trying to figure out how to make sure we're there the next 7. And we've been fortunate to be part of this run up. And I don't mean run up in terms of, market bubble or anything. I mean, the ecosystem being built, real companies kind of being built, or some of the early winners. And that just really accelerating the ecosystem. So we're definitely big believers, and I'm paid to be a believer, so take it with a grain of salt. But I think it's I think it's as exciting as anywhere in the world right now.
On the outside, real outsider in Latin America, when you look at this, you're thinking, hey, there's probably a lot of white space. There's a lot of infrastructure and company profiles that we have in the States or in Europe that probably haven't fully been built out there. Does that make it easier or harder for the next startup to succeed operationally? The easier argument is like, hey, it's white space. You can go build it in. Harder is the industry, the economy hasn't gone through the same series of functional evolutions that maybe we've gone through rep after rep in the States. Now, maybe that scar tissue gets in the way of building the next new thing, or is it creating white space?
So, I think it's both, but to not cop out, I think almost all of them, it makes it harder, and they don't realize it. Meaning, hey, this works here. Let me bring it here. Some version of this needs to exist, and they don't have the kind of realization that you just described. I think that one of the major differentiations of the big opportunities is the lens that makes it easy. It's, hey, I have this insight, but I know it has to be different, and I know that it will be hard, And so because I know these things before, it's actually easier. Is the reason why it's easier in that sense is when you do it right, you're in a market that is it's much less dynamic than the US. It's much smaller, but you're in a market where you can really distinguish yourself early, and that has a lot of kind of power for scaling, raising capital, attracting talent, doing things, and then that gives you the freedom to do things the right way. And so I think it's one of these markets where, and this is true in any startup, there really are no shortcuts, and you have to do the hard work. And the sooner you kind of realize that, the better off you're going to be, because it's that much harder in a lot of these markets. And so I think the real kind of flaw is thinking it's easy because you've seen the model somewhere else and then not realizing how hard it is.
So you're based out of Tampa, Florida. How do you pull off being a Latin American focused investor from the States?
I'm very lucky that to be accepted, honestly. So before COVID, I was on a lot of planes, building a lot of relationships, and now, of course, my life is a lot more kind of Zoom and video. But no, I think it's a very humbling question, because when I first showed up in Sao Paulo in 2016. Visiting, Creditas and Nubank and some other entrepreneurs, like I was certainly an outsider by, almost any definition. But kind of, I think what we found as QED and what I was able to kind of be part of was bringing some of the, skills and experiences that we had and trying to help entrepreneurs. And I think, as a fund, but hopefully it's a little bit about me. This is true too. But as a fund, when you're actually helpful and part of a good story, it kind of builds upon itself. And so we make no mistake. I think we are extremely fortunate to have some of that wind at our backs. But I think at the same time, we've been very willing to roll up our sleeves and do the work. And that work isn't, hey, let me introduce you to this kind of local politician or this local potential client. It's much more, hey, here's how you manage risk. Here's how we should set up our organization. Here's kind of what we've seen in other markets. Here's who you should talk to, in terms of, financing markets. So there's certain things we're able to do and not able to do. And I think we've just let me say this way. We've tried to own that and not kind of under promise and over deliver, if you will. So I've been incredibly fortunate. A lot of it is right place, right time. And, I was just in Brazil last week and very much look forward to going back in a few months.
One of the subtexts of that question is there's a lot of cultural cues that we all rely on when we're meeting other humans, right? We look for how they communicate, their voice inflection, commonalities, commonplaces, things that help us kind of navigate or figure out good, bad, right, wrong. And they're base level stuff that we probably learned in childhood. How do you figure out, as a team investor, which is part of your thesis, I know, how do you kind of figure out the right profile of a founding team or a founder when you're looking at the Latin American market? What signal can you find that translates, that helps you identify, hey, this is the kind of person I want to back?
Yeah. Well, I mean, it's an amazing question, because it's something that, I think is one of the most important investing questions. And I was, I'm still a relatively new investor, period. So I've got that challenge as well. But going into COVID, I was very much reluctant to invest where I hadn't met, in person. And I think it's still a hard thing for us to accept, but I think it's a little less culturally than your question implies. A lot of the entrepreneurs we talk to, we know people they've worked for, went to school with. It feels the same as any other market. And I think we have our ways at kind of referencing and trying to get to know people. But for me personally, it really is about spending the time to get to know, who you're about to, get married to, because, we're trying to take this long view and know we're going to be stuck together especially if things go well, for the next 7+ years. Um, and yeah, I mean, but to, it's definitely challenging at times to try to do it over Zoom. And there's probably a little bit of a bias that, we need to get rid of as well, just because, you've liked things that you've worked with in the past, and sometimes that can get you, investing in people who look like you or have done the same things as you. And, we know that's not the best way to attract the best talent either. So we're constantly looking at it. I mean, we just hired someone in Sao Paulo, which I'm extremely excited about, to join our team, and I think it's going to help us with a bunch of, local efforts and helping, really show the market that we are kind of there to stay, and we're here to kind of, take these businesses to the next level.
Okay, but I'm not going to let you off the hook that easy. What is the founder profile for you for Latin America? Certain type of experience you want to see? What are you looking for?
Yeah, I mean, I think we don't really screen founder profile, but I think we're looking for, very, very tactically, somebody who, I mean, again, it's very generic saying, because it's not like, but somebody who really understands the problem, where they've worked in the space, studied the space, somebody who, both understands the local markets, right, which we're trying to get through referencing and through kind of questioning, and, who we know and what we've seen, because remember, we now have 7 years of history in these markets. We're looking for somebody who, has humility, right? Who's open to being challenged, who doesn't, is willing to admit they don't have all the answers. We're looking for somebody who wants a partner in building their business. This is one of the harder things to get. You're also looking for somebody who has, enough kind of ambition and willpower, and, the ability to attract talent. So, I mean, it's all of these things, and I don't think that, there's maybe a little bit of like over indexing on our network because it's further away geographically, but it's pretty much the same, as what we look for globally.
Now, one of the things,
did I cop out twice?
No,
did I get it that time?
No, but that time you went for it at least, which I appreciated. One of the things that's challenging about a lot of other geographies that I think American entrepreneurs take for granted, we saw it a lot in Europe, is when you've got these geographies that are split up into a lot of smaller population states relative to the enormous spread of the states. You're very often dealing with different languages, different regulatory regimes, different cultural dynamics. And in the States, it's not seamless, but it's pretty close to it. And that makes it a really attractive, aggregated, large market. What are the challenges folks are facing as they're going from Mexico to Colombia to Brazil and back? I know those are 3 of the big hubs. What are any tips or issues you're seeing as companies try to conquer the entire expanse of the market?
Yeah, well, just first of all, I think we totally agree with your point that crossing borders isn't seamless and hard. And so a lot of what we try to do is, look for opportunities that can be underwritten in a single geography, or kind of clear paths to kind of expanding geographies. So that's been a little bit of a, cheat or crutch that we've used to try to, and it's why we're mostly in Brazil and Mexico, versus some of the other markets, because they're sizable enough and, homogenous enough. Now that said, companies that are crossing over and all the directions and permutations that you just mentioned are having various challenges. I mean, particularly entering Brazil is something that is very, very hard and very different. I mean, it's obvious you have a language barrier, but it's also just culturally, what the kind of business networks are. It's just a very, very different market than the others. And so, we have companies like Kavak and Bitso and Betterfly, Tribal, Zubile are all entering or have entered Brazil over the last couple of years. And, they've, I think, mostly gone in with eyes wide open, but it certainly hasn't been, set up hire a country head and never go down. I mean, some of these founders are living in Sao Paulo, are trying to kind of integrate. Some of them are doing things that's a little bit more inorganic, making some acqui-hires or acquisitions to help supplement. But that's a very, very tough one to move. I think the Colombia to Mexico one we've seen has been a little more smooth, given some of the kind of, again, business network overlaps and just the traditional there. So, but what we're really, unless it's something we would say is a truly kind of global business, we're advising companies to stay in their markets until they're tapped out. And we view it as a flag. If you're an early stage company trying to expand markets too fast, that either that market isn't as big as you think, or your product isn't as good as you think. It's kind of a focus question as well. And sorry, I know I've gone on longer than you wanted for this one, but the regulatory regimes, I think we take a lot of time to really try to understand that, because that's one of the biggest things for some of our companies, is making sure, when you enter Mexico in the banking space or lending space, you have to be regulated a certain way. Your companies get looked at a certain way, and so those are the real barriers that we're kind of looking for, and making sure when the companies actually do cross borders, they're doing those things with eyes wide open on the risk side.
Yeah, the other dimension of this that comes to mind for me is the currency risk. How do you guys manage against volatile currencies? Not like the U.S. is always the most stable these days, but
yeah,
you're dealing with a bunch of different currencies just as you're spreading, to new market opportunities.
So I mean,
any hacks for that?
No hacks. Long-term orientation and hope for the best. I think we realize there's going to be volatility. We realize we're taking some currency risk. I think there may be some implied hedges we're making in terms of how much resiliency we see in the business, through margins, or maybe we're entering in a better kind of price versus global peers. But there's really no trick to it. It's almost impossible to hedge. What your portfolio is worth and what it's going to be. We do invest in dollars and expect to exit in dollars, so it's definitely a risk. And again, I think the best answer we've had to it is, hey, you're going to go through these cycles, and you're not going to be able to exactly time exits and cycles, and so you need a company that is going to have the optionality to work through it, if need be. So if anything goes to plan, and we see it more as a IRR risk, if you will, just in terms of timing, as opposed to existential or principal risk.
Very much appreciate that. You've been at this for a while. You've seen a lot of reps now, right? You've been at this since 2013. You're going on 10 years. What's the most important thing you've learned as an investor? Any wisdom you could leave behind?
So I've only been doing this since the beginning of 16, so it's even shorter than you said, which is even more humbling to be asked the question. And in some respect, I've been looking at the market since then. But look, I think the thing that I keep coming back to is just the people that you work with and how important that is. Everything's not going to go right. It never does. It always takes real time and real work, and so you want to be with people on that journey who you respect, you want to work with, who be willing to work for. and kind of have that kind of partnership. And so I still think that, I underestimated that for longer than I could have. And we've been fortunate to work with some amazing people. So some people teaching me the lesson on the positive side. So that's probably the biggest one for me, and the one that I, continue to put the most focus in, how to get to the right relationships and right answers.
Mike, thanks for taking the time today.
Mark, thanks for having me. It was a lot of fun. Appreciate you grilling me on a few of these things, and look forward to crossing paths, maybe in Latin America.
Love that. Mike's the man. Really appreciate him taking the time to give us a little lesson here today on fintech in Latin America. There's not a lot of US VCs focused down there yet. I think that's going to be showing up more and more. So it's great to get his insights fairly early in the development of the capital ecosystem. If you liked what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter @MPD. And to hear more of my conversations with innovators, subscribe on YouTube or any major podcast platform. Just search for Innovation with Mark Peter Davis.